Welcome back. During this third part of Chapter 5, we'll talk briefly about the conservatism principle with respect to inventory valuation, what companies do when they make an error in inventory, and a couple of more tools for your financial analysis toolbox. We explained how to assign costs to ending inventory and to cost of goods sold using one of the four costing methods. However, accounting principles require that inventory be costed at the market value, that's the cost of replacing inventory when market value is lower than cost. Merchandise inventory is then said to be reported on the balance sheet at the lower of cost or market, or LCM. Market in the term LCM is defined as the current replacement cost of purchasing the same inventory items in the usual way, and a decline in replacement cost reflects a loss in the value of inventory. When the recorded cost of the inventory is higher than the replacement cost, a loss is recognized. When the recorded cost is lower, no adjustment is made. And LCM is applied in one of three ways. First, to individual items separately. Second, to major categories of items. And third, to the whole of the inventory. Here's some information on inventory items of a motorsport retailer. Take a few minutes and review the information. The first indication of a problem is that total market is lower than total cost. We see 287 is less than 295. This would cause me, as a controller, to take a hard look at the different items in inventory. With the increasing use of technology, companies are applying a lower cost or market to each individual item separately. And this is how we'll look at the example. Where do you think you have issues? The Roadster and the Blazer have market values lower than cost. The Roadster's market is 140 versus total cost of 160, and the Blazer has total market of 35 versus total cost of 45. We'll need to write these values down specifically with an adjustment. First, identify the lower of cost or market for each product. For the Roadster, we would be selecting the market value of 140 because it is lower than the cost of 160. Continuing down the chart, we would select the lower of cost or market for each item in inventory. At the end, we would determine that our inventory should be $265,000, and we'd make a $30,000 adjustment to debit cost of goods sold and credit inventory to reduce our general ledger balance from $295,000 to $265,000. Errors in inventory may arise as a result of many different things. Normally, an employee miscounting inventory during a physical inventory, or entering invoice or receiving report quantities incorrectly into the computer system. Unfortunately, inventory errors have the ability to significantly mistake both the balance sheet and the income statement for 2 years. I've seen many errors occur for different reasons in my previous lives, and believe me, when inventory errors of a significant amount are identified, everyone takes it really seriously. First, the cause of the error is researched to ensure it is an isolated mistake and not a problem with existing business procedure. Secondly, the error and its financial impact are communicated to management. Third, an adjusting entry is made to correct the error. And finally, policies and procedures are updated if the error was caused due to poor internal controls. On the other hand, if the error was not significant, not material in accountant talk, generally no adjustment will be made, and the error will self-correct in the next period. This exhibit is in your textbook, Exhibit 5.10, and illustrates the effects of inventory errors on key amounts in the current and next period's income statement. I'm not going to spend more time on this subject because it's fully described in your textbook. Your homework will also help you learn what happens when there's an error in inventory. What I want you to know is that errors may be caused for a number of reasons. They will self-correct over 2 periods. And finally, just because they self-correct does not mean it's okay to ignore them. The financial statements for 2 periods will be incorrect, and if the error is significant, the financial statements should be adjusted when the error is identified. Chapter 5 has 2 financial analysis tools that are widely used in business to evaluate how efficiently and effectively inventory is managed. Earlier chapters described 2 important ratios used in evaluating a company's short-term liquidity. Those were the current ratio and the acid test ratio. A merchandiser's ability to pay its short-term obligations also depends on how quickly it sells its inventory. Inventory turnover, also called merchandise inventory turnover or simply turns, is one ratio used to assess this and is calculated as cost of goods sold divided by average inventory. This ratio reveals how many times a company buys and sells or turns over its inventory. Users apply inventory turnover to help analyze short-term liquidity and to assess whether management is doing a good job controlling the amount of inventory available. A low ratio compared to that of competitors suggests the inefficient use of asset. The company may be holding on to more inventory than it needs to support sales volume, or similarly, a very high ratio compared to that of competitors suggests that inventory might be too low, and that may cause lost sales if inventory is not available when customers would like to have it delivered. Inventory turnover has no simple rule except to say that a high ratio is preferable provided inventory is adequate to meet demand. This next ratio measures how well the level of inventory meets sales demand. Days sales in inventory, also called days stock on hand, is a ratio that quantifies how much inventory is available in terms of the number of days sales. It can be interpreted as the number of days one can sell inventory if no new inventory items are purchased. This ratio is useful in evaluating the liquidity of inventory and is calculated as ending inventory divided by cost of goods sold times 365. Now notice that the days sales in inventory focuses on ending inventory and it estimates how many days it will take to convert inventory at the end of a period into accounts receivable or cash. Days sales in inventory focuses on ending inventory, where inventory turnover focuses on average inventory. Nice job with this chapter. Thanks for hanging in there. And in Chapter 6, we'll talk about everybody's favorite subject, cash. See you soon.